There is an equation from financial physics that does not ask whether a technology is useful. It asks something more dangerous. Is the crowd pushing prices upward faster than the reality can deliver profits? That equation is called the log periodic power law. And if it's applied to the AI boom, the warning is not that artificial intelligence is fake. The warning is that a real technology can still produce an unreal price. Right now, AI related stocks represent something close to 44% of the entire S&P 500's total market value. Nearly half of the most important stock index on earth is now, in some way, a bet on artificial intelligence continuing to deliver on promises that haven't fully arrived yet. Companies are borrowing hundreds of billions of dollars to build data centers the size of small cities. Chip demand is straining electrical grids, and underneath all of it sits a single, elegant, physics derived equation that doesn't care whether AI is real, useful, or transformative. It only cares about one thing: whether the crowd's belief is accelerating faster than the underlying reality can keep up. By the end of this video, you are going to understand exactly what that equation says, why it doesn't give you a crash date, and why the actual danger might not be that AI fails. It might be that AI succeeds, just not quite fast enough to justify everything already staked on it. This is the deepest, most technically rigorous video this channel has ever made. Let's get into it. Before anything else, the same honesty this channel has given you in every single video. The log periodic power law does not predict the exact day an AI stock market crash will happen. Anyone telling you a physics equation can hand you a specific crash date is either wrong or lying to you. What this equation actually estimates is a critical window, a stretch of time during which positive feedback, accelerating prices, and investor herding become genuinely unstable. Here's the deeper story underneath that honest caveat, and it's more interesting than a fake prediction anyway. The AI bubble, if it bursts, will not necessarily burst because AI fails in any meaningful sense. It may burst because the market eventually discovers that three separate things: AI progress itself, AI revenue actually collected, and AI infrastructure spending already committed are moving at three completely different speeds. Prices today are implicitly betting those three speeds will converge. The entire question this video is built around is what happens if they don't. Let's look directly at the mathematics, because this is genuinely one of the most elegant equations in all of econophysics, and understanding its shape tells you everything about how bubbles actually behave. The log periodic power law model is commonly written as the natural log of price at time t equals a plus b times the quantity critical time minus t raised to the power m plus c times that same quantity raised to the power m, multiplied by the cosine of omega times the log of critical time minus t minus phi. I know that's a mouthful, so let's translate it into plain language. P of t is simply the asset's price. T is time. T sub c is the estimated critical time, the moment the model flags as unstable. A represents the theoretical price as the bubble nears its end. B measures the strength and direction of the accelerating trend. M is the power law exponent governing how sharply that acceleration curves. C measures oscillations layered on top of the trend. Omega controls how frequently those oscillations occur, and phi is simply the phase, positioning those oscillations in time. The genuinely unusual feature sitting at the heart of this equation is the term critical time minus t raised to the power m. As time approaches that critical point, the price can rise faster and faster. The growth rate itself accelerates, while the oscillations around that growth become more and more frequent. In market language, each correction gets followed by a faster recovery, and the time between corrections keeps shrinking. Prices don't just rise, they rise while wobbling in an increasingly rapid tightening rhythm, right up until that rhythm becomes unsustainable. That pattern reflects genuine positive feedback, and it's worth walking through the loop explicitly. Prices rise. Rising prices attract attention. Attention attracts new investors. New investment pushes prices even higher. And higher prices get interpreted by everyone watching as proof that the original story was correct all along, which attracts still more attention. And the loop continues, tightening and accelerating with every cycle. This equation wasn't built specifically for AI. It comes from financial bubble research associated with physicist Didier Sornet and decades of study into collective market behavior. Its intellectual connection to physics comes from treating a market bubble the same way you treat a physical system approaching a critical transition, genuinely similar in spirit to a material approaching a phase change. The exact same kind of criticality we explored in our video on market crashes. Generally, here's the single most important hidden fact buried inside this entire framework, and it's the detail almost every casual discussion of this equation gets wrong. T sub C, the critical time, is not necessarily the date of a crash. It's better understood as the date at which the existing growth regime becomes unstable. From that point, three genuinely different outcomes become possible. The first is a sudden crash. Investors rapidly exit and liquidity disappears almost overnight. The second is a sharp correction. Prices fall meaningfully, but the underlying technology itself survives and continues developing. The third, and the one that gets discussed least, is a regime change. Growth simply slows down, volatility rises, and prices gradually start following actual earnings instead of narrative and expectation. This distinction matters enormously for how you should think about this entire topic. A bubble can genuinely pop without the underlying technology disappearing at all. Think back to the dot-com crash. It didn't destroy the internet, it destroyed valuations that had assumed internet adoption would immediately produce enormous near instant profits. Plenty of companies from that era disappeared entirely. But the surviving infrastructure, the fiber optic cables, the data centers, the foundational technology later became extraordinarily valuable, just on a completely different timeline than investors had originally priced in. The same pattern could genuinely happen with AI. AI remains useful. Data centers continue operating. Chips remain strategically critical, but companies that were priced for extraordinary, near immediate future profits get repriced, sometimes brutally, to reflect a more realistic timeline. Recent research, a 2026 study proposing a volatility robust bubble detection method called SVADF, makes a genuinely important contribution here. It separates real explosive price behavior from ordinary periods of high volatility and finds different bubble timing and intensity across different AI exposed companies rather than treating the entire AI sector as one single identical bubble. Here's a reframe that changes how you should think about this entire topic and is worth taking seriously before we go any further. Don't describe the AI bubble as though it's one single object. It's actually a stack of connected expectations layered on top of each other. Semiconductor companies sell the physical hardware. Data center operators provide the raw computing infrastructure. Cloud companies rent access to that infrastructure out to customers. Foundation model companies build and sell the actual AI systems. Application companies promise productivity gains built on top of those systems, and enterprises at the very top of the stack are expected to eventually become paying customers, generating the revenue that's supposed to justify everything beneath them. Investors are betting that all of these layers together will produce extraordinary future cash flow. And here's the danger hiding inside that structure. A failure in just one layer can ripple through the entire stack. A cheaper algorithm could reduce demand for expensive computing. An electricity shortage could delay data center revenue. Enterprises might experiment enthusiastically with AI but refuse to actually pay premium prices for it long term. Customers might use AI features without ever increasing their software subscriptions. A new chip architecture could make existing infrastructure investments obsolete overnight. A model breakthrough could dramatically reduce how much computing power a task actually requires, undermining the very demand the whole stack was built to serve. The Bank of England has specifically warned that the AI asset story extends well beyond model developers and chip manufacturers, reaching into networking, storage, cooling, data center operators, utilities, commodity markets, and countless other suppliers. Their estimate AI-related stocks represented roughly 44% of the S&P 500's entire market capitalization as of October 2025. That gives us one of the strongest, most important lines in this entire video. The AI bubble does not need AI to fail. It only needs one layer of the AI stack to grow more slowly than investors expected. Here's a distinction that trips up even sophisticated investors, and it's genuinely central to understanding valuation risk. A company can post excellent, genuinely impressive revenue growth and still be sitting inside a bubble. The real question isn't whether the company is growing, it's whether the company's stock price is rising faster than its actual ability to generate future cash. A stock can be perfectly justified by strong growth if profits eventually catch up to the price. But if that price requires an almost impossibly clean sequence of future successes, everything has to go right in order. With no major setbacks, the valuation becomes genuinely fragile even while the underlying business looks healthy on paper. The Bank of England reported that AI exposed stocks carried a median forward price to earnings ratio of approximately 31 times compared with roughly 19 times for the broader S&P 500 as of early October 2025. Crucially, they noted those valuations could still be justified if the projected earnings growth actually materializes on schedule. That's the crucial nuance worth holding on to. A high valuation by itself is not proof of a bubble. It becomes genuinely bubble like specifically when the assumptions required to justify that valuation become increasingly unrealistic. Stacking optimistic assumption on top of optimistic assumption until the structure gets fragile. Here's what might be the single most dangerous mechanism in this entire story, and it's genuinely under-discussed relative to how much it matters. The most dangerous part of the AI boom may not actually be stock market speculation itself. It may be the quiet transition happening underneath it, from cash-funded investment toward debt-funded investment. The Bank of England reported estimates that AI infrastructure spending could exceed $5 trillion over 5 years, with roughly half of that financed externally, mostly through debt rather than existing cash reserves. Let's sit with the specific numbers here because they're genuinely staggering. Estimates cited include $5.2 trillion in data center capital expenditure required by 2030, $2.9 trillion in AI infrastructure spending between 2025 and 2028 alone, roughly $1.5 trillion of that spending coming from external capital rather than company cash flow, and approximately $800 billion of that potentially coming specifically from private credit markets. Here's the crash mechanism this debt transition creates, and it's worth walking through step by step because it's genuinely different from a simple stock market correction. Companies build data centers based on expected future demand. They borrow money to build them faster than cash flow alone would allow. AI revenue then grows more slowly than originally expected. Capacity sits underused, but the debt still has to be serviced regardless of whether that capacity is generating revenue. Investors respond by lowering their valuation assumptions. Falling valuations make refinancing that debt considerably more expensive. Companies respond by cutting new orders, sending a second shock rippling outward to chip makers, utilities, and suppliers throughout the stack. That's how a technology correction stops being a story about stock prices and becomes a genuine financial event with consequences reaching far beyond the tech sector itself. Here's a genuinely important investigative angle that deserves real scrutiny, and it's more subtle than simple fraud. The pattern can look something like this. A large technology company invests directly in an AI laboratory. That AI laboratory then commits to buying cloud computing services from that same technology company's own ecosystem. The cloud provider, in turn, purchases chips and data center equipment from a chip supplier. The chip supplier records that purchase as revenue, and investors, watching from outside, interpret that revenue as evidence of independent organic market demand for AI. To be genuinely fair here, this doesn't mean every transaction inside this pattern is fake or improper. Real value can genuinely flow through arrangements like this. The hidden issue isn't fraud. It's a harder, subtler question about whether the spending represents new external demand or whether it's simply money circulating within a small, tightly connected group of financially linked companies counted multiple times as it passes from one pocket to another. The question worth asking every time you see impressive AI revenue numbers is this: if company A funds company B and company B spends that money on company A's own cloud services, how much genuine economic demand was actually created outside that circle? This is a different, more nuanced question than traditional fraud. It's a question about the underlying quality and independence of the revenue being reported. And it's exactly the kind of structural detail that gets lost in headline growth numbers. Here's where this entire story stops being purely about software and finance and runs directly into the hard, unglamorous limits of physical infrastructure. AI is frequently presented as a software story, code, algorithms, elegant mathematics. But its actual valuation increasingly depends on physical infrastructure that takes years, not quarters, to build. The Bank of England notes that frontier model training capacity has grown at roughly 5 times per year since 2020, and that future models could require somewhere between 4 and 16 gigawatts of training power. They also cite an estimate that global data center electricity consumption could more than double by 2030, reaching a level higher than Japan's entire current electricity consumption as a country. This creates a genuinely little known physics limit sitting underneath an apparently purely digital industry. A model can be improved with more computation. More computation requires more chips require more electricity requires transmission infrastructure, power generation, and cooling systems. That infrastructure takes years to plan, permit, and physically build. Stock prices, meanwhile, can rise in seconds based purely on expectations about all of that infrastructure eventually existing the market. In other words, can price in AI's future growth long before the physical world is actually capable of delivering the power required to produce it. And it's not just an abstract electricity problem. The Bank of England estimates that each megawatt of AI data center capacity may require somewhere between 20 and 40 tons of copper. A meaningful slowdown in AI construction wouldn't just hit technology stocks, it would ripple outward into copper markets, utility companies, uranium producers, and data center financing arrangements across the entire economy. Let's build a practical framework you can actually use. And I want to be upfront. This is not an established academic equation the way the LPPL model is. This is a documentary framework combining the economic variables most likely to reveal genuine fragility, built specifically to make this abstract topic concrete and usable. Picture it as a fraction on top: valuation expectations multiplied by capital expenditure, multiplied by leverage, multiplied by market concentration. On the bottom, real cash flow multiplied by utilization, multiplied by independent demand. As the top of that fraction grows relative to the bottom, bubble stress rises. In plain terms, bubble stress climbs when stock prices rise faster than actual earnings. when capital expenditure rises faster than AI revenue coming in the door, when debt increasingly replaces operating cash flow as the source of funding, when a small handful of firms dominate an entire index, the way AI related stocks currently dominate a huge share of the S&P 500, when data center utilization sits below expectations, meaning expensive infrastructure sits partially idle, when customers experiment enthusiastically with AI products but don't actually renew their subscriptions, when revenue depends heavily on financially related companies rather than independent outside demand, when electricity and chip supply become genuine bottlenecks, constraining growth, and when analysts keep raising future estimates without comparable matching cash flow evidence to actually support those increases. Here's the honest caveat that matters most. A genuine crash warning would require several of these indicators appearing together simultaneously, not merely one high price to earnings ratio in isolation. A single elevated number by itself tells you very little. A cluster of these warning signs, all appearing at once, tells you considerably more. If you've been with this channel for a while, this entire video should feel like the third chapter of a story you already know the shape of. Our video on market crashes generally introduced you to critical phenomena, power laws, and the idea that markets approaching instability show measurable warning signs before the actual event. Our housing video applied that exact same criticality framework to a second, completely different asset class and showed you the same underlying mathematics, critical slowing down feedback loops, power law tails reappearing in a different context. This video is the third application of that same core thesis, now pointed directly at the most talked about, most consequential asset class of the current moment. Different technology, different numbers. The exact same underlying physics of systems approaching instability. Let's come back one more time to what this equation can and cannot actually tell you, because that honesty is genuinely the entire foundation this channel is built on. The equation cannot tell us the exact day AI stocks will crash. It can tell us when the market is becoming dependent on acceleration itself, when every single quarter must be better than the last, when every data center must be filled to capacity, when every model must keep improving on schedule, and when every investor must simultaneously believe the future is arriving faster than the current price already assumes it will. That's not a prediction machine. It's a genuine framework for understanding exactly where fragility tends to accumulate. So here's what I want you to actually walk away with today. The AI bubble, if it exists in the way critics fear, will not necessarily burst because artificial intelligence stops working or stops improving or turns out to be a passing fad. It's far more likely to burst, if it bursts at all, because AI progress, AI revenue, and AI infrastructure spending are quietly moving at three different speeds, and the market's current prices are implicitly betting those three speeds converge on a timeline that may simply be too optimistic. Watch the stack, not just the headline. Watch the debt, not just the stock price. Watch whether revenue is genuinely independent or quietly circulating within a small connected group of companies. And watch the unglamorous physical bottlenecks, electricity, copper, chips, that no amount of investor enthusiasm can accelerate past their actual physical construction timelines. The AI bubble may not burst when artificial intelligence stops improving. It may burst when improvement continues, but not fast enough to justify the money already committed to chips, data centers, electricity, debt, and expectations. In the end, the bubble's critical point is not where AI stops working. It is where the future becomes too expensive for the present to finance. If this kind of thinking, where physics quietly explains the parts of finance nobody else is willing to explain, is why you're here. Subscribe new videos every week, breaking down the hidden math behind money. See you in the next one.